Let's do it.
Hi, everybody. Welcome to our first crypto fund panel. Thank you for dialing in. Today, I've got three really leading fund managers. Two of them have just had a discussion which one was there first on the panel discussion. This will be a series, so we will expand going forward and have fundamental discussions like today. We will also discuss with DeFi funds, long, short, etc. in the future. This is the kickoff. It's been received pretty well, so we have a lot of registration. I'm really excited to hear the audience questions. So to get started, three fund managers here. I've Justin Bons, who's the founder and CIO of Cyber Capital, Roland, who is a portfolio manager at the Altana Digital Asset Fund. Altana is a boutique that manages multiple cryptocurrency funds. And then also Paul Otto, who is Chief Investment Officer of the F5 Crypto Fund out of Germany. So we have three different jurisdictions here, maybe three different fundamental ideas on where we want to go. So without further ado, let's kick it off. I'd like to start with Paul. Maybe you can, as a way of introducing yourself, just formulate your core thesis at F5 in one or two sentences, and then we'll go around. That'll be your chance to introduce your beliefs and yourself.
Okay. Hi, Maximilian. Great to be on the panel. I'm Paul Otto from F5 Crypto. I'm the Chief Investment Officer. We believe that information systems like who owns what, that stuff that takes care of property rights, is best represented digitally, right? Not on paper, but in some sort of digital format. And the best digital format is not the government database, but it's probably an open blockchain. So we believe that a lot of information systems are going to migrate to open blockchains. And with that, the usage of those blockchains going up, the price of some of the native tokens will go up. And we at F5 Crypto try with our research department to find out which blockchains are those and which tokens are those that will thrive in the future.
Thank you. Roland?
Thank you for having me, Maximilian. And I'm lucky to be here alongside everyone else, all these panelists. Our core thesis is that, in general, which is very broad, is that blockchain has the potential to disrupt numerous trillion-dollar industries. And as a company and as a fund, we're here to navigate the storm of volatility and choose the winners. A bit of what happened, similar to what happened after the dot-com bubble. And in terms of what we actually look at is that we are a close follower of Vitalik's vision, especially for the next cycle, which we believe will be the next couple of years. And we believe that his thesis is playing out, and the Ethereum ecosystem is definitely one of our highest conviction bets in the space.
Perfect. Thank you. And now, Justin from Cyber Capital.
I'm Justin Bons. I've been a cryptocurrency researcher, full-time cryptocurrency researcher for close to a decade now, and I'm the Chief Investment Officer for Cyber Capital, which is a long-term investment fund focused on cryptocurrency, researching the fundamentals.
Okay, perfect. So, I mean, Roland, you mentioned already Ethereum ecosystem. That's something we've definitely have on the agenda today. I'd like to take a step back first and talk about Bitcoin a little bit and start with Bitcoin. I know there are some maybe controversial opinions. I know there are some companies here that have a strong history in Bitcoin as well. So I'd like to just pick off the topic here and start with the question. In your opinion, does Bitcoin belong into every portfolio, let's say, or how does it stack up against the alternatives? And feel free to shout over each other. I don't know, Roland, you're nodding, so we'll go with you first, and then
I think we should start with Justin.
I was hoping you would go first, but that's okay. So I've been a long-time critic of BTC. Obviously, I started back in 2013, and I started off as a supporter of Bitcoin. And I feel in many ways, I still am, but I feel like I'm more loyal to the original principles of Bitcoin in terms of what it was first founded for and its original vision, and even in terms of its economic design. And to answer your question directly, Cyber Capital hasn't held any BTC in its fund since 2017, and I don't think it actually belongs in a professional investment portfolio, because if you look at it, objectively, well, actually, I'll rephrase that somewhat. It doesn't belong in, say, a fundamental based long-term investment portfolio. I will rephrase that, because if you're trading, momentum, or you're doing something like that, that's a completely different set of principles that you're operating on. But in terms of what I'm doing in terms of value investing and what Cyber Capital is doing, I don't think it belongs there, because it doesn't stack up in terms of pretty much all metrics, in terms of its security, having big questions in terms of its long-term security. Where's the security budget going to come from? That being an unknown, in my view, I think is not good enough for something that is supposed to be a store of value and a money. And furthermore, talking about money, I think if something is to be money, it actually needs to have capacity. BTC has no capacity. It's 7 transactions per transaction is not sufficient, to really serve the world. It would take more than 70 years for everyone in the world just to do one Bitcoin transaction, and that includes attempting to onboard them onto Lightning, which includes several transactions. And on top of that, I'll make this my final point, so I'll give the others a chance to respond. I actually think its governance is effectively highly centralized. And all of this talk about Bitcoin not having governance actually acts as a smokescreen for the people that are effectively in control and are able to determine the rules of the system. And I'm talking about, Bitcoin Core here, having over 98% of the clients over BTC. And I think that is a very severe form of centralization, especially if you combine that with, the dominant culture, which is that if you go against Bitcoin Core, as we saw in the block size debates, is very much considered an attack on Bitcoin. So what that means is that, one individual basically has the final say, over the code. I mean, just like any dictator, there are limits to that power, but I still think that is, a dictatorial form of governance in nature. So, yeah.
Okay, so you took out the shotgun, essentially.
I feel attacked.
Any
I feel
rebuttal
attacked.
from anybody? Yeah, go ahead, Paul.
Right. So your question was, does Bitcoin belong into every portfolio? And of course, that simple answer is no. There are certainly functions that you try to optimize where Bitcoin is not a part of. But let me say it like this, right? Everything you can potentially invest in has certain properties, and Bitcoin has some very unique properties. So, for example, it's an asset without counterparty risk. It's an asset that you can store securely. It's an asset that has a volatility, a price history that is different from a lot of other assets. So if you plot it into like a high dimensional space, Bitcoin is going to be this outlier thing. And if you try to optimize a portfolio based on some function, then very likely Bitcoin is going to be part of that portfolio, just because its metrics are out there in a very unique space. So just from a portfolio optimization strategy, if you try to look at it without any emotions, Bitcoin is going to be part of most optimal portfolios. Now, in terms of is Bitcoin supposed to be part of your specific portfolio? Well, that depends, right? What is your unique goal? And I would be interested what alternatives Justin proposes. If he says Bitcoin is bad for the reasons he listed, what's actually better? I find it difficult to find something that's better in all aspects, such as long-term security budget and so on. But yeah, that's my take on it. Bitcoin is supposed to be part of most optimal portfolios, just because its metrics are such that it's a unique position in the available asset space.
If I might just shortly respond, and I'll be short, I promise. So I don't agree with you with the first 2 points that you made, because I don't think those are unique. The ability to secure no counterparty risk. This is a general feature of cryptocurrency. So it's not fair to say that that's unique to cryptocurrency. In terms of its price history, you're correct. But what I'm saying is that its fundamentals are lacking, and therefore it's an emperor that wears no clothes. And I think that's a risky proposition for an investment portfolio.
Yeah, I mean, I'm sure you're aware of the arguments, right? So people say Ethereum changes its protocol every now and again, so that makes it fundamentally insecure because you don't know what will happen in the future. Whereas Bitcoin, well, hasn't changed its consensus. But I
don't think that's true either, right? Like you have SegWit, you had RBF that was released recently. I mean, the narrative is that soft forks are okay and hard forks are not. But I really think that's, if I'm being frank, is kind of BS, because a change is a change. If you look at it from the governance perspective, you can even change the supply with a soft fork. Does that make it okay? I don't think it does.
Well, it depends how you define change, right? If I'm running old node software and you do a soft fork to change the supply on your soft fork, then I can just ignore that on my old client and still be in sync.
But how
So
practical is it to run a Bitcoin node that can't see half of the network's transactions and can't even verify them? That's I think, not a fair way to say, well, that's fine because now, and another thing, hard forks require active consent versus soft forks being passive consent. I would say active consent is a much better form of governance, making it harder to change.
Roland, quiet observer. You want to chip in?
Well, yeah, I think my view is a bit of both. As a brief background, at Altana Wealth, we have launched our first digital assets investment vehicle back in 2014. Back then, majority of what is investable in digital assets was simply Bitcoin. So we are long-time investors in Bitcoin. However, my fund was launched in June of last year. Well, we believe that was the bottom, then FTX came. But my fund is focusing on the expansionary phase of the next decade and the scaling of blockchains. So as a result, similar to what Justin mentioned, my fund has never invested in Bitcoin and will never invest in Bitcoin because Bitcoin lacks composability, which is the key aspect that we look in blockchains and their utility. One can view Bitcoin as being gold and Ethereum as being the S&P 500. Ethereum is composable. You can build on top of it. You can create ecosystems. You can create companies. You can bridge it to real world assets. While Bitcoin, you can't really do much with it. I haven't heard anyone holding Bitcoin and telling me how excited they are to be holding Bitcoin. You can't do anything with it. So I think that the long-term conceptual arguments are good, but often in a long-only fund such as ours, you have monthly or quarterly liquidity, and those investors want to see some performance. And I think whether you like it or not, on the medium term, so maybe years, Bitcoin will likely do well, and Bitcoin, and as this year, was a good hedge for your portfolio. It was not only it was a good hedge against the banking crisis, and I think that it's a good hedge against many future unknown risks. And when people talk about Bitcoin as being a hedge against inflation, I see it as it's not a hedge against a rising CPI, but it is a hedge against fiat debasement on the long-term horizon. And in the past, it has succeeded to do so on a long-term horizon. So if you would have been worried about Bitcoin's long-term utility, which would potentially come in maybe decades from now, you would have missed out on the recent performance. And my fund is typically agnostic, and we have time horizons that span across a couple of years because it is very hard to predict what will happen in more than 3 or 4 years in this space. It's quite a nascent space, and it's rapidly evolving to the upside and sometimes also to the downside, as we've seen in the recent events of last year. So I do agree with Jason's long-term uncertainty, but I think that we'll have to see it play out, and it will be tough. Long term, I do believe that Ethereum has all that is necessary to succeed. But I see both sides of the argument.
That's fine. Always good to have an overview. And I think what a perfect segue to move on to the second point of discussion. So, keyword Ethereum, layer 2s, I think scalability. So let's begin with layer 2 solutions. I mean, kind of the topic of the hour. Everybody was talking about it. Arbitrum airdrop recently. So I'd like to, I guess, as the first question is what your opinion is on fundamentally on layer 2 solutions as a way to, scale Ethereum and get it to, let's say, the next stage of adoption and development.
Well, I think this relates to what I like to call, maybe I already called once, it's called Vitalik's vision, which for the listeners who don't know what that is that Vitalik has a vision of solving ETH scalability issues by using ETH as a base layer and using layer 2s as a scalability solution on top of Ethereum. And initially, when I first heard that, it was quite interesting to hear about. It was maybe something that would happen in the future, maybe not. But actually, we're seeing it in real time. We are seeing Arbitrum taking a spotlight and having almost more transactions per day than Ethereum. You have almost more volume on the Arbitrum trade than on Ethereum. So I think that his vision is becoming increasingly more developed, and that is what we are focusing on. And this will be enhanced in the future when sharding will be launched, as layer 2s will be increasingly more competitive, as layer 2s are a result of the layer 1's tech capacity. And as the Ethereum's layer 1s will improve the tech capacity, as Vitalik has pointed out in the roadmap, also will layer 2s become increasingly more scalable.
Good point. So I think connecting a little bit back to increasing capacity in layer 1s, right? And I think the idea, if I may humbly involve myself as a moderator, is that at least in the case of Ethereum, and I think Justin will go off of this as well, is that there has been, in some sense, to an extent, a move away from scaling the layer 1 because we're now employing layer 2s, and that comes with its own kind of risks and opportunities as well. So Justin, I'm sure you'll be happy to point out the risks, and then maybe Paul will have a
yeah, no, I'm very happy to talk about this. It's honestly been my biggest disappointment in this cryptocurrency movement over the last years. Not FTX, not the regulations. No, actually the pivot of Ethereum away from layer 1 scaling has been my biggest disappointment, I think, in cryptocurrency recently. Having been an early supporter of Ethereum, even from when it was launched, mining it even in the first week, I really bought into that vision. And that vision for a long time included scaling Ethereum through sharding, through execution sharding specifically. And, rather quietly, I think, relative to the significance of this change, I feel, its roadmap has pivoted completely away from scaling the layer 1 to even having discussions of reducing layer 1 capacity and really just leaning into layer 2 scaling, which in my view is the wrong solution. I don't think that layer 2s are a good solution to scale the layer 1 whatsoever. I do think that layer 2s can be useful in specific cases, in specific use case where it makes sense to have a layer 2, like a decentralized exchange. Maybe that requires an extremely high capacity. But I think arbitrarily restricting the layer 1 and furthermore not pursuing technologies that will allow us to safely scale while preserving decentralization, I think, is the biggest mistake Ethereum has made. And that has been a source of a deep, deep disappointment. And look, I really admire Vitalik, and I think he's a really great person. But I think something has gone really, really wrong in the Ethereum ecosystem now because of this. And I think this does also connect to governance, since I'm also an advocate of L1 scaling through sharding, obviously, but I'm also an advocate of on-chain governance. And Ethereum very much lacks on-chain governance, hasn't even been through a few processes where it's gone through rejecting, that very idea. And I think what I'm very concerned about, and what I think is in some ways, you refer to it as Vitalik's vision, and I really see it as a repeat of history, because this is what happened to Bitcoin as well, right? Like Bitcoin decided to not scale its layer 1 in favor of layer 2s, right? This is not a new idea, right? And, I can expand more why I think it's such a bad idea. But I think what is a very corrupting force in this ecosystem is when you only have, say, a few million worth of funding for layer 1 development, and you have funding in the tune of billions. That's if you count, things like tokens in L2 development. That creates a massive bias to favor L2 development over L1 development, even if that's not the correct choice. I think that's a massive problem, even to the point of some layer 2s just straight up buying client implementations like Prism. I think this is a massive corrupting force, and I think scaling through layer 2s is the wrong choice, especially now that alternative blockchains have actually proven that sharding is viable. There's several blockchains today, Ton, Near, Elrond, and more, that have implemented sharding. And sharding is a method of horizontal scaling that allows you to preserve decentralization while also scaling the layer 1, giving everyone the advantage of that layer 1, instead of the UX nightmare and the trust trade-offs and the use of bridges and all of this stuff that comes with, scaling through a layer 2. So that to me has been just the biggest disappointment. And that's something I'm going to be focusing more of my work on, is exploring that.
Just to step in here,
Right.
I think that money, as Justin mentioned, follows narrative. and they're both kind of follow each other, and then narrative follows money, money follows narrative. And it's a fact that this year has been mainly about layer twos, especially on Ethereum. Optimism, Arbitrum have been stealing all the show. Now everyone is hyped up about ZK Sync. And maybe sometimes that's not true. That's not good for VC investors to forget about the core beliefs and their core tech beliefs in this ecosystem and just invest in what is shiny and what they think that will have the most returns. And I think that is the downside of having such a fast-paced and liquid investment environment.
All right.
Go ahead.
So let me go back one step, right? So we have this new information system of the blockchain, which allows you to have strong property rights. You control your tokens, you control your coins, your currencies. Now, the problem is if everybody wants to use that system, there's not enough capacity, right? We can't decentrally store every small transaction that happens in the world, right? If I make a bet at a poker table, that can't be on the Bitcoin blockchain. There's just too many of those. So what do we do about it? And some people say we need to make blockchains that have more capacity. And there's been many tries to doing that. And as Justin points out, there's still development going on that he thinks is very promising. And then there's the approach to say, well, we take transactions off the main blockchain to compute them somewhere up, maybe roll them up into little packets, and then just put those little packets back on the blockchain. That's the layer 2 scaling solutions. And I think we're still early in the blockchain space that we need to explore every possibility for scaling. And I think it's too early to call winners or losers. I'm fairly interested in how the different layer 2 solutions make their trade-offs, right? So the problem is when you roll those transactions up is who does the rolling up, who controls that, how do you verify which transactions actually happened off the chain? That's very difficult. And then if you instead scale on the layer 1, right? If you do sharding, then who has strong enough hardware to even verify all that's going on? Running a validator on some of these newer, larger layer 1s is not really possible. I have my own Bitcoin node at home. I know that my Bitcoins are there. I can verify them myself very easily. I just type a command and get it. I can't really do that on those modern blockchains as easily. And I personally believe the layer 2 scaling progress we're seeing is good. It's fast enough. There's users onboarding. Now, there are definitely those problems with the crypto economics, right? Some of these new scaling solutions don't introduce a token, then they're not really interesting. They're not really growing that fast. Some of them do introduce new tokens, then everybody just talks about the tokens and everybody wants to get rich quickly, of course, which is not always great for making the best development decisions. So there's certainly problems, but I'm generally excited to see the layer 2 solutions being built out.
So I just, if I may quickly, I don't feel like you said that it's not possible to verify sharded blockchains because it's so demanding. The whole point of sharding is that you split up the load so that it's easy to run a node, right? That's how it's able to preserve decentralization because it scales with demand, right? And then it shards, itself in a dynamic way, right? So I don't think that's quite fair to say that. I mean, from my view, being able to just directly use the layer 1 is a better user experience than having to choose between layer 2s and interoperability between layer 2s and, losing trust. I mean, all of these layer 2s right now are highly centralized, right? So it's like if everyone could just have the advantages of layer 1, that's a better system. And I think that scalable blockchains today, prove that, right? For that matter, I will say Bitcoin doesn't actually need sharding to scale, because it has smart contracts, right? You can literally increase the block size limit, on Bitcoin with a few optimizations, and you can run the Visa network off a 10-year-old laptop, right? Which is why I think restricting that block size is so ridiculous. But it's true that, if you have Turing complete smart contracts on the blockchain, that creates way more strain. And that's why we need execution sharding to solve that problem. And I think that, Ethereum's, and also in terms of giving the market options and deciding, look, if you decide to restrict the layer 1 more than it needs to, you're deciding for the market not to pursue layer 1 scaling. You're deciding not to develop the technology, right? What I'm saying is that scale the layer 1 and layer 2s can compete, right? But if you arbitrarily restrict the layer 1, forcing people onto layer 2s, I think that's the problem. That's what sabotages the entire chain. And for that matter, any blockchain that scales is going to be far more successful at hosting layer 2s as well, right?
But Justin, what would
Yeah.
you say about the surge and potentially starting on Ethereum, and that will also boost the layer twos?
So I don't think that that's entirely well. The thing is, that's the thing, that data, right, can't be used for execution. So they're purely doing data sharding, and the idea of that is that, you know, data sharding benefits the L2s, but it doesn't allow a significantly larger amount of transactions on the layer one. So it still has the same effect of moving capacity over. But you are correct in saying that it does make L2 competition more effective. You are 100%.
To some extent, definitely.
Yeah.
And I think that everyone in the space can make their own arguments, whether we'll have layer ones and layer ones with bridges in between them. Will we have a layer 0 connecting multiple layer ones? Will we have layer ones and layer twos winning? But I believe that all of us are believers of the multi-chain future, and that there is not only one chain to rule them all, and that depending on what utility is for that chain, and feel free to tell me what you think, you may have different chains to suit your needs.
I've been such a doomsayer in this panel. I would like to at least make some positive points after this, but go ahead. Sorry, I didn't mean to interrupt.
I hope you agree with me. Or
yeah, I do. I really do. I really do. I'm a believer in this space, you know, because that's why I'm critical, because I love it, and I want it to succeed in good time. So
yeah, definitely. I believe that multiple chains will be winners. And for all listeners, just a fun fact that I quite like saying is that in terms of adoption, when comparing blockchain to the internet, we're around in the late 1990s. So this is very early stage, and there will still be decades to come, and maybe we'll have even more interesting discussions about which blockchain will be the winner. There is room for even new blockchains to come and take over. There is room for existing ones to continue growing, but I believe that one should keep an open mind in this space, as it's very fast paced, it's rapidly evolving. And as we have a panel about fundamental investing, in my opinion, is not only about the tech. Yes, we can argue that the tech is very important, and of course it is very important, but if you have good tech and no marketing, nobody's going to use your tech. So your tech is kind of irrelevant, and you can use it with your friends at home, potentially. I believe that fundamental investing is a mix between the tech, the marketing, the team, tokenomics, and everything plays a little role in the success of your protocol. Because ultimately, as we have a duty to our investors to perform. I don't think our investors will necessarily, I mean, they do care about what we invest in, but they just want that performance. Whether they want, when they invest in asymmetric long only fund, they typically want those asymmetric returns. And they want us to invest in what we believe will have the outsized returns. And sometimes in digital assets, the best tech is not always the best performer. And we have seen protocols which promise to do many things and never do anything, and they have outperformed everything. And I think that is part of the analysis that one should make when fundamentally investing. It's also about the narrative, it's about the sentiment, it's about what the users want. If everyone trades on Arbitrum for whatever reason, although there could be a different layer which is much better than Arbitrum, but nobody uses, what will you most likely invest in that is also Arbitrum? So I think that we should, yeah.
Sorry to interrupt. I just think you're making a good point, and it ties in very well with an audience question that we just received. So that's kind of the one I'd just like to post to everybody, because, you know, like you said, basically narratives are also very powerful. We have actually two different people that are kind of
more professional.
Yeah. Two questions from the audience that are quite similar. So I'll just try to bundle it into one, and it's basically about the key methods you use for evaluating and making a decision whether or not you want to buy a coin. So we spoke about the tech and the belief in the tech, but the question is, what else do you look at, like token utility, number of users, maybe transactions per second, kind of, and I guess transaction per second is a tech thing again, but what are the different angles you take when you're doing the research? What are you diving into, and how do you arrive at your decisions?
So I just want to echo, I 100% agree with what you said before as well. And I think there's a really important distinction to be made here. There is, you know, people that invest on hype, there's traders that are day trading, and there's fundamental investors. And I think fundamental investors, it's a very different kind of breed of person. Let's say, you know, you spend more time reading white papers than we do looking at price charts, I think on average. and it's very much investing in, you know, what has merit, and it has to be a holistic approach, as you correctly put it as well. You know, you have to think about the politics of the system, you have to think about the network effects, you have to think about the governance of the system, which is distinct from the politics of the system. You have to think about the marketing, the brand recognition, the cultural aspects. You know, there's so much to consider beyond just the technology. And I think that's also vitally important to take that holistic approach, which is why I think it has to be multidisciplinary in nature as well.
Just as a funny little comment, I have a very good friend of mine, which is one of the largest validators in Europe. And he told me he stopped looking at the tech just because he's so much of a critic and he knows it so well. And many times he has refused to invest in certain protocols because he didn't like the tech, and those protocols have generated outsized returns.
But that's a gambler's approach, right? Like that's where I like to draw a distinction between gambling and investing. I know sometimes that can be a fine line for people, but I think the difference is, hey, I can just get into Dogecoin, and if I get out, I make a lot of money, or something like that, right? But you're not investing on fundamentals, and I think there's a distinction, and I think there is a conservatism and there is an elimination of risk occurs if you really invest according to fundamentals and not just trying to jump according to that hype train. That's a way of protecting investors as well, you know, and keeping them safe, because you're not investing in anything BS. You're investing in things that are legit, you know, that are high quality with, you know, really high merit. And I think that's important. That's something that investors value, I think, as well, along with, you know, maximizing profits. But I think over the longer run, that is a very good way to maximize profits through a form of value investing.
The only way. Otherwise, the bear market comes.
So if you're talking about value investing, I think that this is kind of the key question. And let's see if you're willing to give it up. But like, so what are the things you're looking at? Are there like key metrics, or what's something that stands out in the utility? What are, like, you know, maybe some rules of thumb that you would say are relevant, except the way the tech is set up? Let's say you're happy with the tech. What else needs to be there?
Well, for me, on-chain governance is a very important factor. I think as a fundamental and as researchers, we spend a lot of our time thinking about some of the big questions in cryptocurrency. And then by answering those big questions, I think, you know, our investments become self-evident, I think, to a large extent after that. So in that regard, yes, I think on-chain governance is a very important factor. And when looking at things, you know, like some of the basics are like things like distribution and inflation. I think one thing that I think Ethereum has pioneered, and I think is just absolutely fantastic, is its economics. Right. I think it's sound economics history. And I criticized Bitcoin earlier because I don't think it's a good store of value, because I believe it will most likely need to increase inflation in the future in order to stay secure. But I think the solution to that problem is actually having a system that has a low tail inflation combined with fee burning, because then you get the best of both worlds. The network actually becomes deflationary during times of high activity and still manage to stay secure during times of low activity. I think that is just the holy grail of layer one crypto economics. And as far as I'm concerned, all blockchains should have this design. And you know, supply caps are just unreasonable in my view, because it doesn't account for, you know, potential periods where fees might be low, and that would be a disaster in a blockchain without inflation.
Paul, what about you? What are your bullet points, let's say, that need to be ticked off?
Right. So we're, of course, trying to maximize return for investors, and sometimes taking the super long view of 10, 20 years into the future is not the most promising. We need to take some more mid-term views as well. And for us, when we analyze a project, first we go through the negatives, right? So we try to kick projects out, which is this even a token that can be traded on a reputable platform? Is this a token that can be safely stored? Is this a token that's not controlled by a single individual? Or is this not a token? Oh, I'm getting icons here from doing this. Very nice. Is this is the TVL that's used by the project all coming through one bridge? That is a risk, right? That you have a single risk that if it realized, the whole project goes down very quickly. So first, we make sure that the whole protocol, the whole token is solid. And then one thing, which of course is the most important, is the valuation, right? Is it currently overvalued, undervalued? And ideally, we find projects which are undervalued. Now, the big question is, how do you do a valuation in crypto when you don't have a cash flow to look at? And this is, of course, where we try to differentiate and try to make judgments that are better than the market. And one simple way that we look at valuation is by comparing projects, right? So if you find two different decentralized exchanges, and let's say they're both having a comparable token model where they get some of the trading fees as revenue in the token, then we just look at a KPI, like a metric, how much trading is happening and how is the token valued compared to that trading. And if we see, for example, one of the decentralized exchanges is much cheaper in this metric compared to the other, then of course, if we decide some of these tokens make sense to invest in, we rather take the cheaper one. So this is one very simple valuation framework that I think people understand.
Yeah, it's very good concrete example. Roland, do you have one as well?
So what we do part of our fund is that we have a top-down approach. And well, when investing, we first look at the layer ones. And if we like the layer ones, then we'll look at whatever is in the ecosystem. So whatever we're looking at near, do we like near? Let's just say as an example, we do like near, then we're going to look at Aurora and everything else in the ecosystem. And the way you value them is quite difficult because you can't have an absolute valuation. You can have a DCF model. But I think that comparative analysis, it works very well in digital assets. And for example, for layer ones or layer twos, you can look at ratios such as the TVL market cap ratio or the TVL FDV ratio, which are quite telling whether this specific protocol that you're looking at is undervalued or overvalued. You have to look at activity on chain. So you have to look at the volume per day. You can look at daily active addresses. You can look at the number of dollars, which is bridged on chain. And I think all these metrics give you a better valuation analysis and allow you to see whether the valuation is high in comparison to its peer group or whether it's low. And this is what we will look at, typical things that we look at when looking at the layer one or layer two. But when looking within the ecosystem, so in our top to bottom approach, and when we look at the bottom, it's mostly about protocols. And the protocol, you have to make a thesis around the protocol. You have to see whether its tokens have utility and what utility will that have. And for instance, as a quick example, we have seen Aave and Uniswap, the holy grails of DeFi blue chips, amazing protocols. Their tokens have been in a bear market since February, March 2021. Why is that? The reason is because those tokens have no utility. It doesn't help anyone. It doesn't help me. It doesn't help them if I hold their tokens. And then you have tokens such as GMX, which is a decentralized perpetual exchange built on Arbitrum, which accrues value to their stakers and accrues value in the way of sharing fees. And the token has been one of the only positively performing tokens of 2022. Why is that? Simply because of the utility. And that also links to Justin's point about tokenomics. Utility should be linked with tokenomics, and better utility should create a better tokenomic approach of the token. And that is why I especially am interested in Ethereum, simply because when looking at the digital assets space since inception, these cycles, the 4-year cycles, how people like to call them, were created because of the halving. And the halving is simply structurally reducing inflation by 50%. And since miners have operational costs, they are structural sellers of Bitcoin, just because they have to fund their own operations. And when this halving happens, typically around 1 year after, the top of the cycle is in. So we have this ecosystem, which is very responsive to changes in supply. And what we have seen ETH now is actually deflationary. So we have something that is infinitely larger than the halving because it is actually now deflationary. And I think that once demand will pick up, we will really see the benefits of having a deflationary token in terms of price appreciation. Yes, there could be differences in terms of on-chain governance. There could be differences in terms of other aspects such as tech, which may or may not be completed. But in terms of price performance, I believe that tokenomics and inflation are truly important in any investment. And we have seen that especially in 2022, in which high inflation tokens and low float tokens were hammered. They're down 90–95%. And currently some tokens are at their all-time highs and some are at their all-time lows. And that is also mainly because of tokenomics.
I would honest, I really agree with everything both you just said. But except for the bit about the halvening, I think that's more due to kind of the psychological narrative than it is about actual supply. But I suppose I'm just kind of quibbling the point
Yeah,
there.
but would you not argue that, okay, so let's begin with the fact. Miners have to sell Bitcoin to fund their costs.
I just the actual inflation relative to supply and relative to volume is so low. I don't think it's a real effect at this point. If you actually look at those numbers,
Yeah, it's also psychological need. I mean, there is
Well,
definitely a psychological
so-
aspect to it as well.
but go ahead. Sorry.
Do miners actually sell their Bitcoin? Well, the way I see it, if you buy mining equipment, you're just buying a long-term option on Bitcoin. So a lot of people actually make the decision, do I buy Bitcoin now? Or do I buy mining equipment which generates Bitcoin for me over the next couple of years?
Probably if you
And
buy a miner and put it in your flat, you will not be profitable. So
Yeah.
Right. So
not
but
very
that's
nice
how that's in the beginning, at least how it used to be. A lot of
yeah.
miners, they were like, well, I have this much money to capital deploy. I can buy Bitcoin or I can set up a mining farm instead. And which one do I choose? And now, of course, it's gotten a bit more towards the direction you say. It's more, hey, I have cheap energy and I'm good at managing hardware, but I don't care about Bitcoin. And then I'm more of a seller. But you actually have those effects that you could say all of the mining is already priced in by the time you buy the mining equipment. You have already made pushed up the price of Bitcoin in the future because you've already made that investment.
I would just like to return to this idea of evaluating cryptocurrencies. So I think that's very interesting. And one of the approaches that we take at Cyber Capital, and we look at all of these metrics as well. But one of the things we like to do is, and by the way, I just like to echo as well, comparative analysis I think is absolutely critical. I think often I'm just upset with every cryptocurrency, and I think everything is flawed, and then I just end up with, well, what's the least flawed? I'm okay with that. I just think we still have a long way to go. And I think for one of the approaches that we like to take is we like to think about, what is the underlying technology? What is the consensus algorithm? And that's like the first thing we ask. And if that isn't any good, like it's centralized, as you say, if it has admin keys, if it has, if it doesn't scale, etc., then we throw it out, we reject it, right? Then we ask, what is the use case? Is it something that people actually want to use? Is it faster, cheaper, more secure, more convenient, right? Is it a better user experience? Is it actually useful, right? But here comes the crux, and I'll make this a short point, that like just because a cryptocurrency has a good underlying technology, right? Just because it has a good use case, it does not mean it's a good investment. And that's where we get into things like, token economics. And that's what I view as good token economics. If I were to just summarize it in one sense, I would say mechanisms, right? A mechanism that creates demand on the underlying token if the platform is being used. So you take that utility, and that utility needs to return to the investors somehow, or create that utility and bring that value back. And that's what we're looking for as investors. And that's where we can, identify revenue. That's where we can, really understand the use case and the usage, and really think about things in these very real terms. And I think that's really important to understand that there's a lot to be very positive about in cryptocurrency. And I've dedicated most of my life to this movement because I really do believe in it, and I think we're really going places. And if anything, I'm maybe more optimistic, thinking we can scale on chain, and that we can do on chain governance, and that we can have all of these use cases and all of these dApps, and that's a bright future.
Happy to see some optimism.
Yeah.
I think that especially the bear market brought the topic of value investing back, because in a bear market, you often want to invest in protocols which are cash flow generating, which makes sense from a simple economic business point of view. Because if your protocol, the only thing it does is burns money, then it's probably not a good investment in the bear market. And Justin mentioned that everything is flawed, and we're going to be looking at what is the least flawed. Yes, that is true. But then we have to also take into account where we're coming from, and we're coming from the fiat system, which is the most flawed out of all of them. So this is a alternative of the fiat system, and crypto and digital assets and their ethos is bringing power back to the people, which they are trying to do. Maybe more, maybe some protocols are doing that better, maybe some worse, but actively we are trying to give back power to the people.
And
I just want to make one more point about what you said about the halving. And definitely with every single halving, we have incrementally smaller marginal impacts, just because the inflation is so small that it won't even matter anymore. But especially in the first couple of cycles, I think the halving was an important catalyst of the cycles, but it will be less so in the future.
I think in the past it was a real kind of symbol for kind of the idea of having this hard money that doesn't inflate itself. But I think over time it's going to be seen more as the halving of the security budget every 4 years. But yeah.
We have one more audience question that I'd like to place with you guys, and like to see your reaction. So the question is kind of your constraints or your guardrails when you're constructing these portfolios, and any approaches you have for downside protection. I'd be interested to see if this is like something that you're just like, oh, that's so annoying, I'm here for the long run kind of, or if it's something you really implement when you're investing fundamentally. What your thoughts are on that?
All right, so let me start. We're incorporated in Germany, so we're overseen by the German banking regulator, and they are giving us feedback to our risk management, our structure of our fund. And there's a couple of rails that we need to fit into. One is that we cannot invest, for example, 100% in Bitcoin. We have a hard cap of 45% in any single asset, which coincidentally is currently approximately the Bitcoin dominance. So that's interesting. And then we have our own risk management system, which basically aims not to have too much volatility in the fund, right? We cannot explain to investors, hey, this month we lost 50%, but that's no problem, don't worry about it. So we very much try to limit the downside to make it more, to make the high volatility in crypto stomachable for our investors.
Quite similarly, we're incorporated in the UK, regulated by the FCA. And we have internal risk management restrictions that we have to use. Those restrictions are that we can only invest 40% per theme. So when you look at the Ethereum ecosystem, that is one theme per layer 1, layer 2. So big blockchains which are scalable and which are composable. And we believe that will be the winners of the next cycle. We can invest up to 10%. And then it will be 5% for the lower protocols within the top-down approach within the ecosystem of a specific layer 1. In terms of de-risking, we are a long-only fund, and we're proud to do that because, in our opinion, you have truly asymmetric returns at this stage of the cycle. When investing right now, I think it's a great time to invest because you have protocols which have stood the test of time and are now having these stress valuations of minus 80%, some of them. What we do to de-risk is that we often de-risk either in dollars or in ETH. And we do that on a discretionary basis when we believe the market is needs a bit of cooling. We also follow smart money tracking. We follow on-chain activity. And with a number of these tools that we use, we decide that it's time to de-risk, and we can be from 0% invested up to 100% invested, but we don't use leverage on top of the 100%. So yes, there will be volatility. We're not afraid of that, and we are here to navigate and to allow investors to put their money to good use with us.
I'm in a similar camp. So Cyber Capital is based in the Netherlands. So we're registered with the AFM, which is the Dutch financial authority here. We also have a fund administrator who confirms, all of our holdings and so forth on a weekly basis. I think fundamental analysis in itself really avoids us from investing in a lot of scams and these things. And we also maintain a high degree of diversification as well, not exceeding 40% for an asset, obviously, and below that having a far greater distribution. We hold around 30 different cryptocurrencies at this stage. Those actually made it past my critique, believe it or not. But and yeah,
it's probably the other guys in the fund saying, "Look, we need to invest in something."
No, really. There's actually a lot of things I really believe in. We don't use leverage. We don't invest in ICOs or pre-sales. We actually want to we only invest in fully liquid assets because we have weekly entries and exits. So we also maintain volume limits as well, so that, our investors are always able to exit, so to speak. So really with that long time horizon, we just have to be very upfront about the risk that involves, is that we don't hedge against downside risk, right? We just have a direct investment in these underlying tokens. And, I think there's always a trade-off involved. Like all opportunity is always coupled with risk, right? So if you take, less risk, if you take more risk, you have more opportunity. If you take, less risk, there's less opportunity. And I think there's a trade-off that, investors, get to choose in terms of what they are comfortable with. And I think one of the advantages of having, 100% crypto exposure as an investment fund is, hopefully this is not 100% of our investors' investment, right? This is a proportion of their investment, and they can mix and match our financial product with, a greater diversified portfolio. And that's really how we see our product as well, fitting, within that spectrum and, what we're able to give. So, if people want exposure to the best possible cryptocurrencies, based on our fundamental analysis, and want that investment, in the best possible cryptocurrencies at all times, that's really what we try to give to our investors, so that they have that exposure. If they have, conviction, in that sense, it very much is a high conviction fund, actually, because we do really believe in the underlying principles, thinking it's going to, eventually take over a lot of finance and a lot of money and a lot of governance and a lot of our organization and a lot of our lives. And this is a beautiful thing that you can come join the journey with us with that.
A really, really good point to make to as an investor, right? To take the approach of, well, you need to look at it as the addition to your entire portfolio, and in what way you would like to, if you would like to add, in what way you would like to add this crypto asset exposure to it. Just to take it back a little bit to, let's say, right, the fundamental ideas behind it. And I think this will probably be our final question. We've got about 7 minutes left. Regarding adoption. So adoption, of course, as a driver of, right, the price of the token as well, naturally. And the question is, what do you believe will influence the adoption rate more in the near term? And it's an audience question. I think it's fantastic. It's focused on DeFi, but I think we can apply it to the whole thing. Is, do you believe that additional innovation, so new technology and innovation in that space, or advancing regulation will either limit or accelerate adoption more? So what of the two are you looking at more, let's say, in the next 2-3 years? No takers. That's
I'll take it then, I suppose. So no, I'll say that I think they're both obviously going to have effect. I think the innovation is unstoppable in many ways. That's one of the things that is so brilliant about cryptocurrency. It's open source nature. And I also think that that's why I'm such a big advocate for on-chain scaling and monolithic scaling and layer one scaling for execution sharding, because that actually gives us the capacity to really use cryptocurrency. I think that if Ethereum had scaled its layer one at this point, I think it could easily have 10 times, 100 times the amount of activity, but we're not to know what could have been, because we hit that capacity limit. So I think that's something that really excites me, and that will happen, regardless of regulation in the long term. But regulation can certainly be a negative force. I mean, I've been in this space for a long time, and I've seen, a lot of regulation come and go. And ultimately, I do believe that we've crossed the Rubicon when it comes to regulation, when it comes to the space. I think that the technology is here. It's here to stay. It's scaling. We can solve, problems. And I think that's, it's like you can slow down technology, but you can't stop it. You can't stop progress. And cryptocurrency truly is progress, because we can build systems that are more efficient, that are more fair, that are more just, and that are more distributed, right? Solving fundamental problems of governance and organization. And I think that's really, a fantastic vision and something I truly believe in.
If I may add, I think what we need is simply time and regulation. Time, I say it because in the bull market, you have large mass of people joining digital assets, crypto, investing, doing whatever they want to do in this industry. Most people are just here with the short term. But then when the bear market comes, you have a number of people, maybe 10% of the people that initially joined, 20%, I don't know, a number, which remain. I joined in 2017, 2016, 2017. In 2018, I remained. And in every single cycle, you have more and more people joining the industry, understanding its benefits, appreciating what we work for and what we're fighting for, and that they will remain. So I think you need time for adoption, and you also need regulation and specifically legislation, because at the moment, it's quite hard to integrate blockchains with real world assets just because you don't have the laws to do it in practice. And I think as these laws will come and you will have integration with real world assets, adoption will come by itself much sooner than it is coming right now. Right now, most of the adoption is coming from retail, and we just want more, let's say, business-oriented adoption, I would put it, in the future. And I think it's coming. I think it's coming, but it will take time.
Right. So I would segment adoption into three broad categories. The first one are the super big actors. So those are like pension funds, insurers, governments, potentially central banks. And those obviously, for them to adopt some new technology, it's going to move very, very slowly. It's going to need to be highly regulated. And I think we're not there yet that these actors are adopting crypto. They're looking at it, they're criticizing it, they're trying to find all the flaws. Maybe they can get some consulting from Justin on that. And so these guys, I think we're going to wait until there's a government that says we're going to put our real estate ledgers on a blockchain like that. That's going to take a very long time. Then the second group of adoption actors I would identify is what I would call, let's say, free actors. So those are like individuals that decide to move countries, right? So somebody who decides to maybe move to Dubai, or a small medium enterprise that decides what to do with their excess profits. Are they going to issue it to shareholders? Are they going to put it in their balance sheet? Are they going to go into crypto somehow? And I think those kind of free actors, those people who take care of their own business, who make their own decisions for reasonable amounts of money, they're adopting crypto at an incredibly fast pace. And I don't think there's any new technology needed for this adoption to continue. So just think about people that got cut off from the banking in the war territories in Europe now. Think about all the new actors coming up right now, like people that live on the internet, young kids that don't have bank accounts yet. They can install a wallet. They're going to use it. The adoption there is absolutely going through the roof right now without any innovation being needed. And the way this adoption grows is, of course, by people being more peer-to-peer. So this is, for example, me explaining to a friend how a Bitcoin node works. This is a kid in school explaining to a friend how to install a MetaMask wallet. I think this is how this adoption goes on. And the software and the educational content for this is constantly growing. And of course, there are risks there, but I see this type of adoption just being in full swing right now. And then the third level of adoption I would see is like the retail adoption, which isn't really financial. So this would be something like people enjoying funny images on the blockchain and trading, Pokemon cards or trading NFTs. This is people gaming on the blockchain, right? They just go onto the browser, they type in, funny game, and they find a game which used to be hosted on a central server, but now it's maybe hosted on a server, but the account is a crypto account, like linked to a blockchain, or the items you win in the game are blockchain-based NFTs on a second or third layer. And those retailers, they're interacting with the blockchain without necessarily knowing what the technicality is behind that. And this retail adoption is mostly driven by the available solutions and how simple and how effective they are. And here, I think we will see more adoption if things get easier to use. So if, existing services like Telegram, like Facebook, they're starting to offer some crypto-related wallets, some crypto services, then this adoption will go up. And this is not financial usage, although it will, of course, at some point go into financial usage. And then the regulator will, of course, step in and say, this is not okay. If you're having loot boxes on those big games, or if you're trading World of Warcraft gold and having people work for those gold. So these are going to be problems that we'll face there. But this adoption mostly relies on great solutions for those, play adoption.
Yes, thank you, everyone. So I think on the question of adoption, to summarize, and I hope everybody somewhat agrees on this, I think we could put it on a timeline in the sense that what we start with is kind of innovation and a great technology, which finds adoption through these, let's call them free movers. I think it's a good idea. And as that grows, it begins to force the hand of regulation as well. And then we will see the big movers, the real heavyweights, start to get interest once it's caught the eye of legislature and let's say the state, because of the adoption that has happened by the free movers. And so I think it makes sense to say that innovation is the driver that in the end will force regulation to either allow it or not. I think we're all on the allowance side, and I don't think there's a way to really ban it, as we all know. So yeah, just to conclude, thank you guys for joining. I think it was really a fantastic panel. I certainly learned a lot as well. We had a very engaged audience, lots of questions. 3 fantastic fund managers, all in Europe. Well, somewhat. I mean, let's say the UK is at least not the EU, but somewhat Europe still. So I think it's also a testament to the ecosystem in Europe that is being built up here. A lot of people are always talking about the US, and I think we really have a massive opportunity in Europe here, and we have really interesting players. So thank you for sharing your thoughts. Of course, none of this was investment advice. Do not make any investment decisions based on what you heard here. Make your own, do your own research. If you would like to get in touch with these funds, these fund managers, they're very easy to find online and on LinkedIn. And that's also it from my side, from 2026 Capital. We are a crypto investment advisor. We are in touch with a lot of these crypto hedge funds, fund managers. We've also developed a database with over 1,000 crypto hedge fund and venture capital funds, which we plan to make broadly available soon. Thank you all. Have a good day.
Thank you, Max.
Thank you.
Thank you, Max.
Okay, so the stream is over.